I'm here with Patrick Donohoe, the author of Heads I Win, Tails You Lose, and the founder of Paradigm Life. Patrick, tell us about your asset allocation pyramid that your clients use to organize their portfolios.
Yeah, so we call it the hierarchy of wealth, and the hierarchy has four levels. We call them tiers. So tier one at the bottom, tier two, tier three, tier four, and each tier is a function of inherent risk and degree of control. And so there are some questions that people are able to answer that allocate whatever investment they're trying to categorize into one of these tiers, and then we have recommended ranges for each of the tiers.
Very cool. And tell us, what is the breakdown on a percentage basis from top to bottom? How do you think about the different tiers?
Sure. Well, I'll answer that question first. So the idea is when you align all of your assets into one of these tiers, the idea is to then try to essentially have the highest returns for the least amount of risk. And because what we find is when individuals have their specific investments, whether it's a rental property or a 401k or a bank account, they don't necessarily have a way to categorize all of those into one model. So that's why we created the hierarchy of wealth back in like 2016. And the idea is, okay, if you have a 401k or if you have a brokerage account or you have cash, okay, you allocate it into one of these tiers, and then you try to figure out, okay, is there another type of asset that has the same or less risk, but I can get a higher, more tax efficient return? And so that's what we discovered, over the years, as far as helping people really understand the value of cash value inside of life insurance, the value of investing in themselves or a business that they own, and obviously trying to get the higher returns than your typical, mutual fund or ETF, which has inherent risk and very little control or influence. And then when you factor in taxes, you factor in fees, right? The net returns are really low. And so we try to help, individuals just see kind of where their assets are so that they can try to find ways to improve their returns without taking on more risk. So the specific allocation, in that bottom tier, we do it in ranges, right? So the range is 30 to 40% in that lower tier. And that lower tier are your more guaranteed, tax efficient assets that are liquid. And then in the tier two is really where there's about a 30 to 40% allocation as well. And in that tier, it's assets that either you and your business, or it's something that's a hard asset that you control, like an investment property. And then tier three is essentially assets that can go down in value, don't have collateral behind them per se, but you have less control. There's obviously more risk. And then tier four is your speculative type of investments. And so in tier four, we typically, try to encourage clients to, have between 5 and 10% at the max. But the funny thing is the pyramid's typically inverted when we talk with clients, right? So the idea is like, okay, how do you evaluate your 401k, the portfolio that's inside of it, and find ways to, minimize risk, maximize returns. And typically you can go 1 to 2 tiers below that tier four and get better returns with less risk. And so yeah, there's a lot of models out there, and a lot of them, are very myopic, specific to an asset class, typically market assets. But this essentially encompasses whether it's the equity of your primary residence, your own business, cash, life insurance, cash value, annuities, 401ks. You're able to put it all into one model and really evaluate it based on the inherent risk, but also the degree of control you have. And that's the last thing I'll say is, that's one thing we discovered, is that there are some clients who have, assets in kind of a tier four, really risky, and they don't know what they're doing. But there's some clients that have the same exact asset, but they know what they're doing. And so those would be classified differently, right? Just based on their experience, their education, their training. So not assets are all equal, right? That's the other thing that's interesting about the typical risk evaluation models is it doesn't consider the individual, right? Our model considers the individual.
That is so awesome. Well, take a look at Paradigm Life to hear more about Patrick Donohoe's approach to portfolio theory.